Some other the cash sources or funding sources that businesses could think about. Number one, there's non-traditional lenders out there that are still lending. So lenders that are more interested in your story as a business and your background, your history, how you approach customers, your customer relationships, long-standing relationships. Those are all factors in underwriting, whereas in traditional underwriting, those really wouldn't be qualifying factors. So there are storybook lenders out there. Caliber has relationships with storybook lenders that we refer clients to when non-traditional lenders fall down. There is asset-based lending. So it's something to think about as a manufacturer, specifically manufacturers. If you have equipment or other things that are sitting around, you can lend against those assets that you have. Now, right now, it is a little bit of a competitive market, or I would say a fire sale market in the asset-based lending space. So you may not get the premium that you're expecting on that equipment that you have, but it is an option for another cash source or funding source. Another area that people don't often think about is their deposits. Oftentimes companies, especially privately held companies, they do have cash on hand. They do have operating cash on hand. And there's two sides to this coin that companies often don't think about. Number one, FDIC insurance. So most people, they may have known at one point, or it may have crossed their thoughts at one point, but they may not be thinking about this. FDIC insurance only goes up to $250,000 per account. So that creates a challenge if you, as a privately held company that is, let's say, $100 million in revenue, let's say you have $10 million in your operating account that's kind of your average balance. Well, of that $10 million in that one account, the likelihood is that only $250,000 of that is insured. And especially in the times that we're dealing with right now, it's really important to think about that, because that could really crimp your cash flow if something happened with your bank and you were only able to pull back $250,000. So there are services that many banks have, additional services that are depository insurance platforms. We work with some partners that have, one partner in particular that I'm thinking of that has over 500 banks that they aggregate the deposit over. Not only do they secure that funding up to those deposits up to 70 million, but they also give a better return. So right now, the market is kind of fluctuating. 3 or 4 weeks ago, the returns were about 1 basis point. Now, the returns from this platform, or at that time, the returns from that platform were around 0.25%. So when you think about it, if you're depositing $10 million and you're only getting 1 basis point back in interest versus putting on this platform and getting 0.25% back, it's a way to gain cash flow. It's a way to put money back into the organization. Another opportunity to get cash or to gain cash for a company is invoice factoring, or I would say invoice factoring adjacent solutions. And these just work on the kind of aged AR that you have sitting there. You can lend against that. You can lend against your receivables and the invoices from your customers. And there's a myriad of different solution sets out there. We work with 2 or 3 in this space that we think are reputable, but it is just another option to look at when you're looking at how to access cash in the business. It's interesting when you think of credit cards as an instrument in accounts receivables for most B2B businesses. I don't know how many conversations I've had with CFOs and VPs of finance where they've really kind of put I think the line from Dirty Dancing, they put baby in the corner. They put credit cards in this box, right? And they only think about credit cards in a very specific way. And in reality, credit cards as a receivables tool they're a very flexible tool that can iterate in a lot of different ways. And so I think one of the things that when we work with clients, we help them first think about their processes, their clients, their invoices, their ARs, and then think about the tools they're already using. And then simply just proposing, well, what if you inserted credit cards as an option for a form of payment here, where most clients don't even think about it because there's a perception of risk, additional exorbitant cost in accepting that, where the reality is that it is actually cheaper as a tool to utilize in accepting payments than many other forms of cash that a business is going to access, like a line of credit or a collections firm, or even the time that you're paying an individual to follow up on an invoice to get payment. So I think that's something that customers don't think of. Businesses don't think of the total cost. And credit cards as a tool aren't a solve-all at all. I always will tell clients, if somebody's willing to pay you within 30 days with a wire transfer or an ACH, take it. It makes sense for your business. Credit cards are an effective tool to speed up all the other things in AR that are lagging. I know that was a whole lot. But before you think about alternative funding options or credit cards as a tool, or even diving into the fine print, the most important thing is to work with an expert, whether it's Caliber or one of our partners that we work with. It's important to have good guidance around how to navigate the credit card process space. Our space is intentionally opaque. You just got to understand that. The people that are issuing the cards are also processing the cards. So it doesn't do them any good for you to understand exactly what's happening. So you need what I would like to call an advocate or a Sherpa in order to help you kind of make the right choices for your business around accepting credit cards and working that as a tool into your accounts receivables process. And I think one of the benefits, or at least one of the benefits, there's many, to having a professional is, number one, they're going to give you a clear view of where you fit in the credit card processing industry. They'll be able to tell you how to kind of separate your company, how to look at your company when it comes to credit card processing. It may make sense to segment it from account to account. It may make sense to use a different platform or system based on the types of clients that you're servicing or the types of transactions that you're taking, as well as the ERP or accounting software that you're using. Those are all factors that a processing professional is going to help you navigate effectively. And at the end of it, you'll have a solution set and a process that's going to fit your company, that's going to help save you money, increase cash flow, and grow with you. It's going to be scalable. It's going to help you grow, which is the tool of all these things that we've been talking about, is increasing that cash flow so you can use that to grow and maintain.